So when you say some states don't allow that or it's not applicable in the state, what is that supposed to mean?
So there, essentially, when this was passed, this 100% bonus depreciation tax law was a federal income tax, part of the federal, tax reform. There were certain states that adopted the same rules on the state level, and there were other states that did not adopt the same rule, which means they still recognize cost segregation. They still recognize the ability to accelerate depreciation. However, you're not able to claim the same 100% bonus depreciation in the first year, which means you'll have to use the regular cost segregation method of depreciation on your state income tax return.
Which is 27 and a half years for the commercial.
Again, 27 and a half plus, and then you can reallocate that to the 5 and the 15-year faster schedules with cost seg.
With the cost seg, you can do that, but you cannot do the year one deductions. That's what you're saying, right?
Correct. Exactly.
Okay. This is the Real Estate Wife Show, and I'm your host, Vinki Loomba, a commercial real estate investor. And today I have a very good friend, Yonah Weiss, with me. Welcome, Yonah, to my show.
Thank you, Vinki. Great to be here.
Awesome. So this is the second time with me. First time I recorded a show with Yonah on mind, body, and entrepreneurship. And if you wanted to check that out and learn about Yonah's spiritual journey, you can check that episode out. That's one of our first episodes. And a little bit about Yonah. Yonah is a powerhouse with property owners' tax savings. As business developer at Madison SPECS, a national cost segregation leader, he has assisted clients in saving hundreds of millions of dollars on taxes through cost segregation. He has a background in teaching and a passion for real estate and helping others. He's a real estate investor and a host of top podcast, Weiss Advice. I love that, Weiss Advice. So today's our topic of discussion is cost segregation, because Yonah is a cost segregation king. And once again, welcome, Yonah. Super excited to have you with me today.
I am so grateful to be here, Vinki. Thanks so much. And congratulations on 100 episodes.
Really Yay! Thank you. So before we get started, so if you can briefly share your background with us. I know it's been a while since you've been on my show. So remind my audience a little bit about your background. How did you become who you are today?
Sure. Well, not to get too deep into the weeds, obviously you can go and check out the Mind, Body, Spirit podcast where we went really deep into that. But I was a teacher for many years. In fact, moved to Israel during college and did a study abroad program, originally from Southern California. But being a teacher really opened up my mind and heart to really helping people and trying to see what I can do for others. And about 8 years ago, I had a little bit of a financial struggle, some health struggles in the family, and really put us into more debt than we were already in student debt. And I was looking for opportunities, looking for kind of new things to do. And real estate kept coming up in conversation with friends and acquaintances of mine who I had, reached out to and said, "Hey, I'm looking for a new opportunity. What do you think?" So real estate kept coming up. I started out doing some commercial mortgage brokering. That was my foray into commercial real estate. Learned from a good friend of mine who had been doing it for years. We did a few fix and flips together, just single family homes out in New Jersey. And then I got my broker's license as well, trying to really learn everything I could. And about 6 years ago, I was introduced to this company, Madison Commercial Real Estate Services, Madison Title. They're very, very big. And also they have a company called Madison SPECS, which is the biggest cost segregation company in the country. And I didn't know much about cost segregation at all. But to my surprise, when I talked about it with friends and acquaintances and people that I had met over the past couple of years in the commercial real estate industry, asked them what they thought, what they knew about cost seg, the surprising answer, which I still get to this day, was most people have no idea what it is, let alone utilize it. And so I saw an opportunity to really just use my skills as the teacher that I was for so many years to see what I can do about just educating people about this subject And that's really what I've been doing. So I've been with Madison SPECS for about 6 years now and have obviously grown a huge social media following through essentially teaching about this subject and figure out ways to give back to the community.
Very smart. So tell me, what is cost segregation?
Well, I'm glad you asked, Vinki. I thought you'd never ask. It's a weird name for a tax deduction. So anytime you buy a piece of real estate, besides for your primary residence, if it's a residential or commercial, it doesn't matter, you're able to take a tax deduction, which is called depreciation. Mm-hmm. Cost segregation is an advanced form of that depreciation. Okay, so think about it like this. If you were to just take what's called the normal straight line depreciation method, you take your purchase price, you subtract a little bit for land, and then you're able to write off the rest of the entire value of the property. But you have to do it over a long period of time. The IRS essentially says, we're going to give you a deduction based on the principle that things go down in value, so they depreciate, but your property is not actually going down in value. We're just going to allow you to write off a certain portion every year over a 39-year period or a 27.5-year period if it's residential. And that's called depreciation. What cost segregation is taking that to the next level and saying there are certain components in the property that actually depreciate faster than that 27 years, like your flooring or your furniture or equipment or appliances. All that actually depreciates on a 5-year schedule. And there are many other things that are on different schedules. And so what a cost segregation is segregating the original cost and saying, yeah, you spent $1 million on the building, but not all of it is building and structural. About 20% of that is actually going to go into the personal items or the furniture or the cabinets and countertops and all those different things. So that's what we do. It's an engineering report or study of the property that allows you to take bigger tax deductions in the earlier years of ownership.
Wow, that's a good explanation. I love that. So let me ask you this. What type of properties are eligible for cost segregation? Like you mentioned earlier, that if it's an investment property, you can do that, not the personal property. So if you can shed some light on that, and then how it benefits the real estate investors.
So yeah, any type of property, I think it has a lot more to do with the purchase price, like the size, not necessarily the number of units or the actual square footage, but the purchase price. Because what we're doing is taking an accelerated deduction, which essentially is a percentage of your purchase price. So generally speaking, I like to say anything over a $200,000 or $300,000 purchase price makes sense to look into getting a cost segregation study done, because the benefits are way beyond the actual cost of getting something like this done, which may cost, minimally a few $1,000s. And the tax benefits are at least going to be 10x that amount.
Mm-hmm. So I heard about the bonus depreciation too. Is there something different than the cost segregation? How does that work?
Yeah, bonus depreciation is like what all the craze is, right? Bonus depreciation. We all want the bonus, but it's really not a bonus. It's not something extra, which it's weird. Like all these names, depreciation doesn't really mean depreciation, right? Bonus doesn't really mean a bonus. It's kind of weird how the IRS comes up with these names for things and just borrows terms, confuses people. I think that's really the main thing. If you confuse people enough, they won't look into it and they'll just think it's something else. No, but the bonus depreciation essentially means like this. Once you've done a cost segregation study, and you've allocated those certain components to faster lives, like over a 5 or 7 or 15-year period, you have the option to take 100% of those accelerated deductions in the first year. So that's what's called 100% bonus depreciation. This was introduced in the 2017 tax reform and was eligible through the year 2022. So if you bought a property between the end of 2017 and the end of 2022, you're able to take 100% of those accelerated deductions upfront. Okay, so it can be sometimes 20 or 30% of the total purchase price as a tax write-off in the first year. Now, this year, it's starting to phase out. So this year, 2023, it's 80% bonus, which means you can take 80% of those deductions, accelerated deductions, in the first year. The remaining 20% can still be spread out over that, faster 5 and 15-year schedules.
And now we know what cost segregation is, right? So taking all these different components and kind of writing off and getting the tax benefit. And we learned about the bonus depreciation as well. So you can do year one, a lot of stuff and take those tax credits. So can you share a real life example now? Because since you are cost seg king, you have done so many of these. So help us understand, how the cost seg works from year 1 to year 5, I would say the total time period, the whole time period for the property. So if you can share that example.
Absolutely. And yeah, I mean, talk about doing a ton of properties in 2022. We did over 7,000, cost segregation properties across the country. So it is a lot, and every type of property. I think I'll give an example of just, some multifamily property. I know that's what you and a lot of your listeners focus on. Let's say you bought a property. I'll pull up an example here just to see the exact numbers. But a property that was bought for, let's see if I can find something here. On average is about 27, like I said, 27 and a half year schedule would be your normal depreciation deduction. So you always want to look, and the first thing we always do before doing a full cost segregation study is run a free estimate showing what the potential tax savings are. And so you can see already what you'll be looking at even before doing it. So in this case, we actually did a property out in Texas, is in a market outside of the Dallas-Fort Worth area. It was purchased, and I know Texas is a non-disclosure state, so I'm not going to say which the property is or anything like that, give any more information, but the property was purchased for $13.5 million. Okay, it was a B-class multifamily property. So without cost segregation, the normal depreciation amount would have been about $417,000 a year. So again, how we arrive at that is take about 15% off for land. It's about $2 million. Right? We're taking that off. We're not depreciating that at all. The remaining approximately $11.5 million is going to be split up into these different categories. So again, our engineers are going to come in and say, X amount is the value of the roof, which is 27.5. That's structural, right? The other structural components like the foundation, the doors, windows, infrastructure like electric and plumbing and all things like that, that's all foundational. It's all structural. All of that depreciates on a 27.5 year schedule. That's going to be the majority. So in this case, it was a little bit on the lower end. It was about 77% of the total amount was going into that 27.5 year period. Okay. So that came out to be about $8.8 million. Okay. $8,821,397. Not approximately, that's the exact number looking at this study in front of me right now. And then the 5-year property, again, those are the components that are going to depreciate on a 5-year schedule. So think about things like the HVAC system, the flooring, carpeting, right? Vinyl flooring, countertops, cabinets, furniture, equipments, window treatments, anything like that, even moldings and millwork. All of that is going to be identified literally piece by piece. I identified every single individual thing, added up, calculated the value of all those components. It was approximately 17% of the property was going to that 5-year category. So again, that's about $1,990,202. So a large amount, again, but close to $2 million. And then you have what's called the 15-year property, which is land improvements. These are things that are outside the building that depreciate on a faster schedule over a 15-year period. That's things like concrete. So you had a swimming pool here, all the concrete in there, any type of, patios or fencing, landscaping, all the grass, everything, all those things and more, all those go into the 15-year property category. This was about 6% of the total value of the property. Again, over $600,000. So total accelerated depreciation here was over $2.6 million, which means they were able to take that $2.6 million. Actually, it was more because if you added the $400,000 from the regular structural depreciation, it was about $3 million approximately of write-off in the first year. Okay, so we're talking about bonus depreciation is for $3 million. That means a $13.5 million purchase, and you get right off the bat a $3 million write-off. So this was pretty good, I'd say, for investors, especially considering that, in this situation where it was about, 775%, loan to value. And so the equity investors were about 25% of the total property, which means they were able to take, just doing quick calculations here, over, 100% of the total investment that went in, they were able to get back as a deduction, as a depreciation deduction in the first year. Okay, so that's above and beyond what any of your income is going to be. This is a really important point over here. We talk about the 100% bonus depreciation and getting back more than your investment. But, having all those extra losses, okay, in this, a simple situation, a person invested, let's say, $1 million into this property. Okay, let's say make it more simple, $100,000 into this property as a limited partner, and 30 other people did like him. Okay, so there's about a $3 million equity going to this deal. They're each going to get back over $100,000 of depreciation deductions, but they only made, let's say, I don't know, $8,000, maybe the first year even less because the preferred returns maybe a little bit lower, $8,000, $10,000. That means they're going to have an excess of $90,000 of extra deductions, of these extra losses. Okay. And what can they do with that? That's where a lot of people get confused, Vinki, because most people think, oh, I get these extra losses. I can just use those deductions to offset my W-2 income and I'll be set. I won't have to pay any taxes, yada, yada. Unfortunately, that's not the case.
Because you said something really good, because you said you, on the $13 million property, there was a $3 million in depreciations. Then you just gave us all the breakdown right there. So I wanted to ask you, how did that magic happen? Because of the leverage, right? Because the equity would have been 20%, 30%. So here the depreciation, you're getting about 30%. I just ran the numbers when you were talking. So if you can tell us a little bit more detail, how did that magic happen? Because people forget, because we're depreciating on the total amount that the purchase price.
Exactly. Now, you're exactly right. We're able to depreciate the total purchase price and then break that down. So if you have more leverage and less equity, that means, in the total stack, that means you will get more depreciation per dollar amount back. Whereas if you bought this property all outright cash, all cash, $13.5 million, that means you're only going to be getting approximately $3 million in the first year depreciation. That comes out to be, and this is, what's the numbers here? Divided by 3 million is only about 40% or so of your total investment. No, that's not right.
30%.
Yeah, 30% of your total, less than 30% of your total investment coming back as bonus depreciation. So this is where a lot of people get confused and think, well, I put in, this amount, and how come, on one investment, I'm going to get back more depreciation per dollar amount. On another investment, it's going to be less. And this is one of the main reasons, especially when there's more equity being raised for, let's say, for value add, for construction, or there's just less leverage. Especially nowadays, it's harder to get financing at a higher leverage. First of all, because just the financing is higher rates, right? The interest rates are much higher, and people want to be safer. They want to be a little more conservative and want to take on less debt. That may be the case. It may not be the case. But what happens is you're diluting the amount of depreciation that would normally go, or in a higher leveraged environment, would go to the investors.
So when you say when there's a higher leverage, then you have a less percentage on the depreciation side? That's what you're saying?
No, higher leverage equals more depreciation per dollar.
More depreciation, because you're getting more back for the tax cutters. Oh,
correct.
Okay, that's what I thought. Thank you so much for clarifying that. So let's go back to now, how can people use those passive losses against their active income, if it's at all possible?
Yeah. And it's really, there are cases when it is possible, but generally speaking, depreciation is considered a passive deduction or passive loss and can only be used to offset passive income or rental income. So if you have investments from other real estate, all of that's lumped together on your Schedule E, and all that can be offset with depreciation. So if you have one investment or you have 10 investments, it's all going to be lumped together, both the depreciation and the income. However, there are a couple exceptions where you would be able to now use that against your active income. One exception is if you or your spouse are a real estate professional. Okay, real estate professional, this is someone who is full-time in the real estate, meaning you own rental properties and your full-time job is either brokering or managing or operating or doing construction, et cetera, on your own rental properties. Now, this is not as common, although if you're a real estate broker or realtor, you're automatically a real estate professional. You just have to also own at least one or two investment properties to what's called materially participate, to actually be actively involved in the running of those businesses. Once you have that, you have you're able to use those passive losses to offset your active income. And this is one of the major exceptions to the rule, and something that I think most people don't know. They're not aware of. They think, oh, if I'm, high W-2, I'll invest in real estate and then I'll offset my W-2. It's not the case.
So, like say you said material participation, but let's say somebody is trying to invest in a syndication, and then they have few properties, rental properties that they are managing themselves. Would they be able to use some of the tax benefits there because they are managing some properties, but they are not real estate professionals?
So you'll be able to use the depreciation to offset the income from all of your properties, all of your rental income, but you will not be able to use it against your active income or your W-2 income unless you have that real estate professional status.
So basically, you have to always remember that these are the passive losses that needs to go against the passive income, whatever passive income that you're gaining from any of your investments. So the other question that I have is somebody told me a long time back that you're able to use $25,000 every year against your active income. How does that apply, or how that rule is applicable for some?
So that's another exception to the rule. However, it's only up to certain income limitations. So if your adjusted gross income is less than $100,000, then you're absolutely right. You're able to use $25,000 of your passive losses to offset your W-2 income. Again, that's another exception. Has to do with the hierarchy of what your income is. Once you get higher than $100,000 of adjusted gross income, up to $150,000, it starts to phase out by basically 2%, per dollar, which means that at $150,000, you're making more than that, you are no longer able to claim that $25,000 loss against your active income.
Oh, okay, interesting. Good to know about that. So, other question that I have is regarding the bonus depreciation. A lot of people talk about that. Oh, year one, you can write off everything. So are there any particular limitations on that law? Like what can you do or what you cannot do?
For the bonus depreciation?
Uh-huh.
So there are certain states that don't recognize the bonus depreciation on a state level. On the federal level, there's no limitations. And, you can use as much as you want, essentially.
So when you say some states don't allow that or it's not applicable in the state, what is that supposed to mean?
So there, essentially, when this was passed, this 100% bonus depreciation tax law was a federal income tax, part of the federal, tax reform. There were certain states that adopted the same rules on the state level, and there were other states that did not adopt the same rule, which means they still recognize cost segregation. They still recognize the ability to accelerate depreciation. However, you're not able to claim the same 100% bonus depreciation in the first year, which means you'll have to use the regular cost segregation method of depreciation on your state income tax return.
Which is 27 and a half years for the commercial.
Again, 27 and a half plus, and then you can reallocate that to the 5 and the 15-year faster schedules with cost seg.
With the cost seg, you can do that, but you cannot do the year one deductions. That's what you're saying, right?
Correct. Exactly.
Okay. So the other question that I always think about it, what is a good time to do the cost seg? I mean, even you can get the free study after that, you have time to decide what time is a good time for me to get all these tax credits.
Yeah, it really depends. I think the biggest thing is it's individual kind of decision to see when the best time, probably the best answer I can give is it's going to be the best time to do when you need those deductions the most. And so it's not going to be the same answer for everyone. I know a lot of people like to get the cost segregation done in the first year of ownership, and a lot of people right away after acquiring the property. And the main reason why they do that is just to set up the depreciation from the beginning the right way. Also, in order to make sure to get those maximum deductions to their investors in the first year. However, it's not something that you need to do in the first year of ownership. You can do it, many years later, and as long as you're still holding the property, and catch up whatever depreciation you missed. So you don't miss out on those deductions altogether. You just miss out in the years that you didn't claim it. Okay, so you're not going to go back and amend tax returns and carry back losses. You're just going to catch up that depreciation in the years going forward. So again, if you have a property where you're not making any money, right? Or you have enough losses or you have enough deductions from other properties, it may not make sense to get a cost segregation done because you're just essentially generating extra deductions or extra losses that you may not be able to use.
So you think in that case, the age of the property influenced the decision as well, because its property is way too old and it might not make sense because it might be like in heavy losses already. So share with me some example there.
Yeah, so nothing to do with the age of the property per se, because again, the depreciation starts over every time there's a change of hands and transaction, which means it's not intrinsic. The 27.5-year depreciation is not intrinsic to the property. It starts over brand new. When you buy a property, even though it was built, 100 years ago, you're able to start depreciating it, again, just a borrowed term, based on your purchase price starting today, okay, in 27.5 years. And you're able to use bonus depreciation. If you sell it in 5 years, that new property owner, the buyer, is now going to start his depreciation over 27.5 years and do bonus depreciation again based on his purchase price. And so it has nothing to do with that. It has more to do with, again, just if you as an individual, let's say I have 10 properties and I've done cost segregation on all of them. So I have $1 million of extra losses that are just carrying forward. Should I get a cost seg done on this new property? I'm not going to be able to use those losses. I mean, necessarily, maybe you will. Maybe you have the sale of real estate. You sell a property and you have a big capital gain or you have a big depreciation recapture tax. You can use the losses from cost segregation to offset that as well. So maybe there is a reason to get it done. Again, it's all an individual decision, seeing when it's going to be most beneficial.
So I think this is the best time to talk about placed in service now. Why that's an important consideration, when you're determining the optimal timing for your cost seg.
So again, place in service has to do when you place in a service. If you have a new property, let's say new construction, it's only going to be placed in service once it's ready to be rented out. So even if you bought a property a few years ago and it's taken a few years to get it up to speed and be ready to be rented, that's when you're going to do the cost seg, is obviously when it's placed in service.
And then sometimes people like not to do the cost seg throughout the whole period when they exit the property and they think, okay, maybe I can just go back and then I can just readjust my counting. That's the terminology I'm going to use here instead of cost seg. So how does that work? Because they are just taking the straight line and then they, at the exit after that, they can just go back and kind of readjust the accounting and just get the tax credits or the cost seg, I would say.
Yeah, so you can't do it once you've exited a property. It's something that you've have to do while it's placed in service, while it's under your ownership.
So you cannot go back and then do the cost seg when you exit the property. That's what you're saying?
So not really. I mean, theoretically, you could do it in the same year that you exit the property. You can't do it after you've exited the property. Meaning, if you sold a property, you can't now say, okay, let me do the cost seg and adjust that. If it's in the same year, then you could. However, it's not necessarily going to be so beneficial because one of the main benefits of cost seg is the time value of money, of using these deductions in order to have having more deductions up front. However, when you sell a property, you're going to be faced with a capital gain. You're going to be faced with depreciation recapture tax as well. And that recapture tax means you're going to be taxed on the amount of depreciation that you took during the hold period. Now, that being said, you're going, if you're doing the cost seg in the same year, then, guess what? You're basically paying back a large amount of the depreciation that you claimed in the same year. So it's going to cancel, a lot of it's going to cancel each other out.
So since you're talking about recapture, let's talk about that. How does that work? And how does that impact the limited partners? Because they might, since they took the depreciation early on, so they might have something to participate in the recapture at the end.
Yeah, exactly. So recapture tax, again, anytime you own a property, anytime you sell a property, rather, you're going to be subject to what's called depreciation recapture tax, which means you're taxed on the amount of depreciation taken. It doesn't mean that you paying back the depreciation, but it means you're going to be taxed on that amount. Similar to a capital gain tax. If you made a profit, you're going to be taxed on that amount of profit. So to here, the profit is looked at like it's an unrealized gain. It's how much you took as deduction. Now you're going to be taxed on that amount. Now there are 3 different calculations of how depreciation capture is taxed in 3 different levels. So some of it's taxed at your ordinary income tax rate. Some of it's taxed at a maximum 25% on the capital gain rate. And so it's a blended rate, which means it's not cut and dry. And there are other ways to actually reduce that recapture tax by using certain strategies, like what's called partial asset disposition. I'm not going to get into too many details here, but essentially how it affects you is that when you sell, you're going to have a big tax on the sale. And so that's going to affect the investors as well. Yes, you've benefited from these losses or from these deductions to pay little to no income tax on whatever money you made during the whole period, but on the sale, you're going to be taxed. The good news is that whatever extra losses that you had from the property, again, go back to our example at the beginning where you had a $100,000 investment and you had, a $90,000 carryover loss. Well, guess what? When that property sells, you don't lose out on those deductions, those extra losses. They actually get released and help to reduce that recapture tax, which means you're going to be paying less because you did the cost segregation in most cases.
So let me ask, since you're talking about recapture, let me ask you this question too. Can you explain the difference between the ordinary income recapture versus the capital gain recapture?
Yeah, so there are 3 different types of property. We broke down the structural components, and the tax code has different names for them. So it's in the tax code, right? The section 1250. Okay, that's called the structural components, the depreciation. There are things that are considered in section 1245, which are the personal property items. Okay, so anything that's structural is going to be depreciated on, again, that 27.5-year period, and is going to be recaptured at that maximum capital gain, that maximum 25% rate. Okay. Mm-hmm. So meaning if you took, $100,000 of depreciation from your 27.5 year, from your structural components, you're going to be taxed 25% of that, $25,000 of that amount. However, of the 1245, which is the personal property, that bonus depreciation amount that we've taken more of, you're going to be taxed at your ordinary income tax rate, whatever that amount is. Okay. It could be 22%, could be 39%. And that is how the 1245 property or the personal property or the bonus depreciation amount is taxed. So again, it's a blended amount. Certain amounts are taxed at this rate. Other amounts are taxed at a different rate.
Because that's considered all of fiction and everything that are considered as a personal property, because that's a movable things. All those comes under the personal property, right?
So yeah, I mean, it's called that. It's not necessarily how you and I would view something as movable per se, because, you don't necessarily move the window treatments or, the millwork from the wall or the countertops and stuff like that. But they're considered as section 1245.
Oh, interesting. That's good to know. So are there any misconceptions regarding the cost segregation that anybody needs to know?
Yeah, I mean, I think the biggest misconception is something that we talked about, is that that the deductions can apply equally to everyone. And that's unfortunately not the case. Another big misconception is that this can only be done on huge, commercial properties. And, that's also not the case. Even on, $200,000, $300,000 single family property can be worthwhile. Another misconception is that it costs, an arm and a leg. And there's like these articles floating around that say it costs like $20,000, $30,000 to get a cost segregation done. That's also not the case. It costs, maybe $3,000, $4,000, $5,000. And so there's a huge disparity between sometimes what you find on the internet. If you ask ChatGPT, he might come back and tell you it'll cost $20,000 to get cost segregation done because he's found some Journal of Accountancy article from 2005 that said that. So you need to ask experts. You need to be aware of what the current market is.
That's a good idea, to always consult the experts on that. That's awesome. So anything new in the cost segregation space?
Nothing new per se that I know of. I think, there's been a lot of talk about the change of the bonus depreciation and if that's going to be reinstated. Mm-hmm. I think there is a high possibility that it may be reinstated in the future, but we've yet to see that play out yet.
That's awesome. I think that was very informative, Yonah, whatever you shared with us. So can you share one more golden nugget with my audience?
Well, the biggest golden nugget you can probably take away from this is make sure that you have a CPA who understands this. And because unfortunately, I'm talking to literally thousands of CPAs over the years, and not everyone understands this. And so you want to make sure if you're going to use this method, you want to make sure they understand it and can apply it.
Yeah, I agree with that 100% because when we heard the terminology CPA or even the lawyer, we just put everybody in the same bucket, like they know everything, but not everybody knows everything. Everybody has their own specialization, like doctors, not one doctor knows everything. So CPA could be different doctors in the different space. Thanks for that, Golden Nugget. Love it. So this brings us to our rapid fire round. And I have some surprise questions for you. You're going to answer in one word or one sentence only. Are you ready?
I am ready. Let's do it.
All right. Let's to the first one. What is the most memorable financial lesson you have learned from the past mistakes?
Ooh, past mistakes. I think not knowing how bad credit card debt was. I learned the hard way when I was young, was in college and short after college, how bad credit card debt actually can get.
I know. I had the same experience when I came from India because we didn't used to have credit cards in India when I came to US. So I didn't even understand the concept of having this plastic. We were just all cash. I was like, why we are using this? Why would somebody give you money on this? Because didn't understand that they're going to charge you arms and legs after that. So next question. What is the best piece of investment advice you have ever received?
Find a mentor and find someone who has been successful in doing what you want to do and learn from their mistakes and learn from their experience and fast track your goals.
I love that. Find a mentor that's going to give you something that you want to do, not everybody's doing, and then follow that. Good advice. Thank you. If I give $1 million to you right now, what would be the first thing that you invest in?
$1 million to invest, obviously.
Yeah, where would you invest it?
You're not just giving me $1 million, to hang out with.
You didn't try yet.
I think right now, I'm mostly focused personally on affordable housing. And I think there is a great need for that. And there's a huge shortage of that in our country. And, mobile home parks and manufactured housing is one of the solutions to that I've seen. And I've seen very successful operators. So I probably put at least half of it into mobile home parks or RV parks, things that are more affordable housing where it's solid operators who are doing good and also good returns.
And how about the other?
The other half, probably Bitcoin. No, I'm just kidding. I think, I think also I'm very much for real estate altogether. So I've seen a lot of success in self-storage as well as multifamily. So I'd probably put, half of that, the other half. So again, a quarter of that million into self-storage investments and the other quarter into multifamily. So diversify it a little bit. And if I can further diversify it, all of those among different sponsors and among different locations, I would do that as well.
Wow, that's a good idea, diversification. I will buy Bitcoin too a little bit. Just kidding. If you could invite 3 famous people, living or dead, to a dinner party, who would they be?
Invite 3 people to a party?
Famous people.
Famous people, huh? I guess it depends what the definition of famous is. I don't know if the people that I would want to invite would want to go to a party. That's the thing. So honestly, no, I since I'm Jewish, I think I would, look to in the past some great sages of our time. So again, I don't know if party would be the right answer, but probably Moshe Rabbeinu, that would be number one. That would be pretty awesome to meet the man himself. Rabbi Akiva, who was a great sage of about 2,000 years ago, murdered by the Romans, and one of the founders of the Talmudic law. And and then I don't know who the third one would be. Maybe go with probably go with my rabbi himself, my personal mentor, because he'd probably get more out of that meeting than I would. So I'd bring him along.
Nice. I like that, because just creating something out of the box and just like expanding your mindset, learning from the sages You cannot do anything better than that. I love that. If you could have a superpower for a day, what would it be and how would you use it?
Wow. Superpower for the day. I think it would be probably to see the future. I think if there's such a thing, right? See the future, and then obviously invest in the right assets. Take that $1 million and go back to the first question and, see where I should put it.
Oh God, that's awesome, Yonah. How can people reach out to you?
The best place you can find me on all the social medias, LinkedIn is probably the most place where I'm most active. You can also go to yonahweiss.com and find me there.
Yeah, exactly. And Yonah's a connector. He's a rock star when it comes to LinkedIn. Thank you, Yonah. I loved the conversation today.
My pleasure. Thank you guys thank you, Vinki, you guys, for having me on the show.
Of course.